We all hear about alpha in investing, that promise of beating the market. But what's that potential extra return really worth to you as an individual investor?
That's the big question, isn't it? And it's exactly what we're digging into today. We've got some really interesting research that looks at this through a different lens.
Yeah, not just raw performance numbers, but something more personal, like your actual satisfaction with your investments, considering the risk.
Exactly. This deep dive is based on a study which tries to figure out the real value of adding active managers to a pretty standard portfolio, a 60/40 equity bond mix.
But
It focuses on investment utility.
utility, okay. So, how happy the overall outcome makes you, balancing the good returns and the bad risk.
Precisely. Because look, a fund might boast high alpha, but if it adds a ton of risk you're not comfortable with, or if it doesn't really improve your specific portfolio much, is it actually valuable to you?
Right. The study suggests that just chasing alpha might be, well, a bit misleading for a typical, somewhat risk-averse investor. The findings here might actually surprise some people.
Definitely challenges some common thinking.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So maybe let's start with the theory, this idea of utility.
Good idea. Lay the groundwork.
Okay, so in this study's world, utility is basically a way to measure how much you value returns relative to the risk you take on. There's a formula, equation 1 in the paper, but the core idea is quantifying that trade-off.
So it helps understand, would you prefer a safe, say, 3% return, or take a gamble on something that might give you 6% but could also give you 0?
Exactly. And that leads to this concept they call the certainty equivalent, or sometimes willingness to pay. They use the terms interchangeably.
Okay, certainty equivalent. What does that mean exactly?
It's the guaranteed return you'd accept that would make you just as happy, just as satisfied as taking the risky bet on the active fund. It's like saying, okay, instead of this uncertain alpha, I'd take this much for sure.
Got it. So that's the benchmark for value here. How much certain return is this active fund worth to me?
Precisely. And to make it concrete, the study first estimates the risk aversion of a typical investor holding that 60/40 portfolio. Using market data from Jan 2016 to December 24,
Okay.
they calculate this risk aversion level gamma, they call it, comes out around 10.4. That number basically sets the stage, telling us how much extra return this kind of investor needs to feel compensated for taking on more risk.
And they show this with indifference curves too, right? In Exhibit 3, like lines showing combinations of risk and return that you're equally happy with.
Yeah, exactly. And the certainty equivalent is basically where that curve hits the vertical axis, the return you take with zero risk. Adding a good active fund should theoretically push that whole curve up, give you a higher certainty equivalent.
Okay, theory makes sense. So how did they test this with real funds? What
Okay.
was the strategy?
Right, the methodology. They took that baseline optimal 60/40 portfolio. Then they looked at, get this, 12,203 U.S. large cap active equity funds from the Morningstar database, again using that same 2016 to 2024 data.
Wow, over 1,200 funds.
Yeah, big sample. And for each fund, they calculated the utility benefit of adding it into that 60/40 mix.
But was a rule, right? You mentioned the equity part stayed fixed.
Crucial point, yes. The total equity allocation had remained 60%. So if you put, say, 10% into an active equity fund, you had to reduce your passive equity index fund holding by 10%.
Which makes sense. That's how a lot of people manage their overall asset allocation. You decide stocks versus bonds first, then pick the fund.
Exactly. It mirrors that top-down approach. Now, they walk through a hypothetical example, which was pretty helpful. Imagine a fund with an expected alpha of 2.5%.
Okay, decent alpha.
It moves pretty much with the stock market beta of 1.0. No real link to bonds, so bond beta is 0.
But it has its own unique idiosyncratic risk of 10%.
Right, the part of its movement you can't explain just by the market. Using their model, they figured out the best percentage of your 60% equity slice to put into this active fund. The overall portfolio's utility goes up by an amount equivalent to a guaranteed 73 basis points, or 0.73%.
Hold on. So the fund promises 2.5% alpha, that's 250 basis points. But the actual utility boost, the certainty equivalent gain, is only 73 basis points. That's way less.
It is, and that gap is really central to the whole study.
So why? Why the big difference?
Two main reasons they highlight. First, that 2.5% alpha isn't guaranteed, right? It comes with that 10% idiosyncratic risk.
Yeah.
Investors, especially with a gamma of 10.4, don't like uncertainty, so they mentally discount the value of that risky alpha.
Okay, risk aversion bites into the perceived value. What's the second reason?
The second is overlap. Even with alpha, a lot of that fund's return is just tracking the market because its beta is 1.0. But you already have market exposure through your index funds in the 60% allocation.
So adding more of the same market exposure doesn't add as much unique value to the overall portfolio.
Exactly. You're already diversified to some extent with a basic 60-40. The active fund needs to add something distinctly valuable beyond just market tracking, and the risky nature of its unique contribution, alpha, gets discounted.
Okay, that clarifies the theory and the example. So let's get to the main event. The results from the actual 12,203 funds. How many of them actually managed to provide any positive utility boost to that 60-40 investor?
This is where it gets pretty stark. Out of those 12,203 funds, only 12%.
12%, that's it?
Just 12% actually increased the investor's overall portfolio utility over that period, even before considering fees.
Wow. So nearly 9 out of 10 funds didn't actually make the investor better off from a utility standpoint.
That's what the data suggested for this time frame and this type of investor, yeah.
Okay, so for the few that did help, that 12%, what was the benefit? What was the average willingness to pay for them?
The average willingness to pay that certainty equivalent boost for those positive utility funds was only 19 basis points, 0.19%.
19 basis points on average. And what about the median, the typical fund in that group?
Even lower. The median willingness to pay was just 7 basis points. So half of that small group of helpful funds offered less than 0.07% in true utility value.
Man, those are small numbers, especially when you think about the fees active funds charge. How did this compare to the alpha the same funds generated?
Great question. So for that same group of funds, the 12% with positive utility, their average traditional alpha, like CAPM alpha, was about 69 basis points. If you used a more complex style factor model, the alpha was even higher, around 108 basis points.
Okay, so wait. These funds were generating alpha on paper, even 108 basis points on average, but the actual utility value, the willingness to pay, was only 19 basis points.
That's the core finding. There's a huge disconnect. The alpha number you see quoted doesn't directly translate into portfolio satisfaction improvement for a diversified investor.
It really shows that alpha in isolation can be misleading. Does high alpha even predict high utility benefit then?
Not really, no. Exhibit 7 in the paper looks at this correlation. It's surprisingly weak. You see funds with high alpha but low utility benefits, and vice versa. The R-squared values are low.
So just picking funds with the highest historical alpha doesn't guarantee you're improving your overall portfolio utility much?
Right. And they even did a regression, Exhibit 8, trying to explain the utility benefit. Even controlling for things like expenses and fund size, alpha itself only explained about a third, maybe 34% of the variation in the utility benefit.
Did expenses matter?
Yes. Higher expense ratios were clearly linked to lower utility benefits, which makes intuitive sense. You're paying more, reducing the net benefit.
Okay, that's sobering stuff about the results. Did they look at potential sort of counter-arguments or different scenarios? Like, what if you're not a 60-40 investor?
They did. They checked robustness. Exhibit 10 shows what happens with different stock-bond mixes. If you have more equity, say 80% or 100%, you're generally less risk-averse.
Right, lower gamma.
And in those cases, the average utility benefit from active funds does tend to increase. If you're more willing to take risks, you value that potential uncertain upside more.
But does it close that gap with alpha significantly?
It helps, but the average willingness to pay still remained, quite a bit lower than the average alphas being generated. The core finding holds across different allocations, just the magnitude shifts a bit.
What about the relationship between stocks and bonds? That changes over time.
Good point. Exhibit 11 tackles that. They tested different correlations. If stocks and bonds become more negatively correlated, meaning when stocks go down, bonds go up more reliably.
Gaps become better diversifiers.
Exactly. And in that scenario, active equity becomes slightly more valuable, potentially adding diversification the bonds are already providing. But even simulating a strong negative correlation, like negative 30%, the average utility benefit only bumped up to around 33 basis points.
So better, but still not huge, and still well below typical alpha numbers.
So quite modest. Helps on the margin, but doesn't fundamentally change the picture.
Did they look at active bond funds too? Or this idea of pure alpha?
Briefly, yes. For active bond funds, Exhibit 12, the results were even less encouraging. Only about 36% had positive utility, and the average willingness to pay for those was just 10 basis points.
Even lower than equities. Wow. And pure alpha, like trying to hedge out all the market risk.
Yeah, they simulated creating synthetic pure alpha funds by hedging out the beta exposure. The idea is to isolate just the manager's skill. You might think that would be more valuable.
Intuitively, yeah. You're getting just the skill part.
But surprisingly, no. The average utility benefit for these beta-hedged funds was actually lower, only 7 basis points on average, compared to 19 for the original funds.
Lower. Why would that be?
The reasoning is subtle. Investors care about their total portfolio's risk and return. While pure alpha might sound good, stripping out the beta can also change the fund's overall risk profile, or lower its total expected return in ways that don't fit as well into the optimal 60-40 mix. It suggests maybe that beta exposure, even if overlapping, plays a role investors value in the context of their whole portfolio.
Interesting. So trying to isolate alpha didn't necessarily make it more valuable in practice for the overall portfolio.
Seems not, according to this analysis. They also looked briefly at what happens if you assume managers could generate much higher alpha, like 2%, 4%, 6% consistently.
Right.
If you assume managers can deliver massive, consistent alpha, far above what's typically observed, then the willingness to pay does go up significantly. But even then, it still lags behind the assumed alpha level, and achieving those kinds of alpha levels consistently is, the big challenge.
Right. That's the $1 million, maybe 19 basis point question. So wrapping this up, what's the main takeaway here?
I think the central message is that for a typical investor with a diversified portfolio like a 60-40 mix, the amount you should rationally be willing to pay for an active equity fund, based on the satisfaction it adds, is likely much less than traditional alpha numbers might suggest.
Yeah, that average of 19 basis points for the funds that even added value, it's a really low number compared to common fees and reported alphas.
It really underscores the need to think beyond just alpha. You need to consider how that active fund fits into your whole picture, the risk it adds, the overlap with what you already own, and ultimately how much it improves your overall investment utility.
And it highlights how important that basic diversification from the core stock and bond allocation is. That's doing a lot of the heavy lifting for your portfolio's risk-adjusted return.
Absolutely. That's the primary driver of utility for most investors in this framework.
So the provocative thought for you listening is this. Given these findings, how should you reevaluate your own allocations to active funds and, maybe more importantly, the fees you're comfortable paying for them? Is the potential utility boost really worth the cost, or could that money be better used elsewhere, perhaps on lower cost diversification? Definitely something to mull over.